Let's get in. David Roche, strategist at Quantum Strategy. David, welcome to the show and a pleasure to speak to you as always on NDTV Profit. Interesting commentary that's coming in from the Jackson Hole Symposium. What do you make of the newly announced policy commentary? Does that tell you that probably there is a shift in terms of strategy?
Oh, I think there's definitely a shift in terms of strategy, and he has signaled that he's going to cut interest rates. So that's definitely on the cards. It's more than on the cards. It's a virtual certainty, and the market will take it as such. So basically that answers your question. You're going to get further interest rate cuts. It'll feed into more equity and other asset bubbles. It will probably not lead to an enormous rise in US long-term interest rates yet, because the whole yield curve will move down if the short-term rates are moving down. But in the longer term, I think the markets will worry that this has an inflationary context or consequence, and therefore you won't get that. And finally, I would say it's bad news for the US dollar because essentially the European Central Bank will not be cutting rates. They're on hold. The Fed will be cutting rates. So if you take a relative monetary policy, it'll drive the dollar lower. There are other reasons to drive the dollar lower, such as the challenge to the Fed's independence, which is another chapter in what's going on between the Fed and the US administration under Donald Trump.
So, David, a couple of points that you already mentioned over here seem pretty interesting. You're talking about a weaker dollar. And that will be pretty much based on the relative interest rates as well, basis, with the capital inflows that could probably capture the asset bubbles, being the dollar is a neutral capital inflow and could be hedged as well. But if you have to look at a simultaneous impact in terms of the bond markets, do you think they will rejoice for a short term? And what happens in the long term in terms of impact?
We're looking at the bond market to answer that question, which is indeed a very good one, because after all, the bond markets are much bigger than the equity markets, and in terms of the economic performance of the US, just as critical, if not more so. So to answer your question on that, I think the immediate impact of cutting or signaling that you're going to change monetary policy and cut short-term interest rates means that people say, okay, well, long-term interest rates are the sum of short-term interest rates over time. So therefore, the whole yield curve moves down in a parallel fashion. Long-term rates, 30-year bonds fall. Short-term rates, 1-2-year bonds rates fall. But in the longer term, the market will worry that the Fed has now demonstrated that despite the existence of asset bubbles, despite the fact that the economic reasoning behind the current shift in monetary policy by the Fed chairman is, to say the least, questionable. I think the markets will then start to worry at the long end of the US bond market. They'll start to worry about the inflationary consequence of a Fed which is looking more and more like Donald Trump's administration. And what they'll worry about is inflation, and the rates will then start to go up at the long end, but not at the short end, which the Fed virtually controls. So what you get is a steepening yield curve in which you can actually short the long end and go long the short end, which is kind of a yield curve investment.
The other aspect I want to touch base with you is the switch that we are seeing in terms of the policy. Do you think it will actually allow the Fed to dodge some of the Trump administration's war against its independence? Because the threatened loss of Fed independence has been an ongoing negative when you talk on the US dollar as well.
Well, the answer to that is no, it won't. It will change the nature of the war, but it will not change the existence of the war. Now, why do I say that? I say that because what Trump wants with the Fed is control. It is not that the Fed would agree momentarily to run with the pack, to agree with Trump's somewhat underqualified administrators. So the Fed now is saying, I'm going to cut rates. Donald Trump wants them to cut rates. So that clearly diffuses one thing, because the hounds are running with the pack. But what Donald Trump wants is control. Now, control means he needs to control the FOMC. So what he's going to do, like we're seeing in the example of Governor Cook, he's going to attack Fed governors down the line where he can find something to attack them about, in order to have them replaced with his appointees, who will, of course, be will be pro interest rate cuts, pro money printing, pro anything you like to give a free lunch. So that war is not over. It's going to be fought in a different way. And the consequences for the dollar are severe. I think in the longer term, it calls into question the independence of the Fed. And without the independence of the Fed, a mainstay of dollar strength is taken out of that, taken away.
With all of this said and done, the expectations, as we know, have now risen for a September rate cut as well. Where do you sit? When do you expect a rate cut, and how many more would you expect now from here on?
Well, as you can probably tell by my puritanical cold look at what the Chairman Powell has agreed, I think the room for an interest rate, a series of interest rate cuts, a trend in policy to lower interest rates is not there. There are just too many uncertainties in what he said, and I think a lot of what he said is just plain wrong. So there will be increasing evidence that the tariffs are not temporary, and they will have a long-term effect upon inflation, productivity, and growth in the U.S. economy, and that limits enormously the room for maneuver for the Fed to cut rates. And therefore, I don't think there is, under any circumstances, is a long-term trend downward rates in U.S. Fed rates. Is that warranted? In fact, I would say the U.S. economy has now got interest rates which are very close to the equilibrium level, and there is no economic justification for going below that. So, to answer your question in that somewhat windy justification of my reasoning, I think you get two cuts, which are mainly political. And I do not think that you're going to get a big trends going into next year with another 3 cuts this year, 2 cuts next year. I don't think you're going to get that.
Interesting. You've also mentioned that Powell's nuanced tone has tilted dovish. So it's not capitulating, but somewhere acknowledging some bit of fragility from here on as well. And it's actually resetting the expectations without locking the Fed into action. That's exactly what you're saying right now. Now, if you have to look at the US markets and the kind of reaction the markets gave in overnight trade, we did see a broad-based rally that was actually led by cyclicals. The rate-sensitive sectors also saw a rally in overnight trade. So mainly your risk-on was the dominant theme in overnight trade. From here on, if you have to look at markets, are you seeing any strategic implication that could continue?
Well, I think the strategic implementation is that you now have a Fed put. And therefore, if the markets go down, the Fed will intervene. And if the markets go up, the Fed will intervene. So where do you want to go with that? The only way you can go is up, but I would advise you to take a parachute. That's the longer term consequence.
Okay. And from a labor market perspective, the kind of commentary, David, that we heard as well, what would this mean for the US markets? Because along with the commentary from Fed, you're talking about US tariffs as well, where it is not only a threat to other countries, but you're looking at a potential threat to the US country itself as well. So taking both these aspects into consideration, how are you expecting that entire aspect to play out?
Well, let me put it this way. He said 2 things. He said that the U.S. equilibrium in the labor markets is at risk because the only reason unemployment is low at 4% is because both the supply of labor and the demand for labor are both going down. So he said if the supply of labor were to stabilize, then if the demand for labor continues to fall, you could have a sudden flip in the markets towards higher unemployment, which the Fed should act to avoid. The difficulty with that arguing is, why would the supply of labor suddenly stabilize? That depends on Trump's immigration policies. More likely to continue than not, there are 14 million or 13 million illegal immigrants in the United States, and his big plank is persecuting them. So I think that assumption that the labor markets are about to flip into huge unemployment is doubtful. The other assumption he makes, or reasoning he makes, is that tariffs are temporary. And he says that temporary in effect on inflation. He says that is because the labor market is so fragile, to go back to his first assumption, that it cannot possibly turn higher prices due to tariffs into higher wages due to loss of living standards. So he says there's no risk, inflation expectations are anchored, etc. Both of those assumptions are doubtful. I've described why the labor market assumption is doubtful, why the tariff assumption is doubtful is because you are changing the US economy from an internationalized, efficient and productive economy into a national economy, a mercantile economy, which uses capital and labor a lot less efficiently and has higher inflation. So I think the second assumption about tariffs depends on the first assumption about the labor market, and I think that is false reasoning. That's why I think this is a major shift in the Fed. I suggest it's not without political influence. And I think it is the wrong thing to be doing at the present time because the evidence for such a shift in policy is simply not there.
Interesting commentary, and that's a strong one. My last question, David, coming to you is the impact we've spoken with regards to where the dollar goes. We've spoken about bond deals. We did see a spike that did come in with regards to gold and silver as well in terms of overnight trade. And apart from that, if you have to look at the way crude panned out, we had Brent and WTI in that range of $63 to $67, $68 per barrel. Do you see any impact on any of these commodities?
I do. Well, first of all, I mean, you have to take into account that the major impact of the Fed's change, or what we saw in Jackson Hole, is domestic. It's domestic investors interpreting domestic economic policy. When you come to foreigners like you and me, then we look very carefully at how we invest and what not only the return on the asset we're investing in, but also how we can make or lose money on the currency. The reason people are buying gold is because what the Fed has done is to undermine the interest rate support for the US dollar. Fine. So if you're going to buy something in the United States, you want to own some gold because it gives you insurance against a falling dollar. The second thing I would say is that on oil, on petrol, on oil markets, you're looking at a different scenario. You're looking at President Putin waving two fingers at Trump and saying, I'm going on with the war. I can always manipulate you. You'll never do anything to me. So bingo, you have no influence of what Russia's going to do. So the continuing war in Ukraine calls into question the credibility of the president. And he will probably get annoyed about this and put on tariffs on countries that use Russian oil. The result of that will be to force those countries to buy Brent or whatever, but not to buy Russian oil, which pushes up the demand for things like Brent, WTI, and pushes down demand for Russian oil. That is why you're getting this relative movement in prices, in oil prices this morning. It's less about Jackson Hole and more about what's going to happen with Russia.
Interesting comments coming in there. But thank you, David, so much for joining us on the show on NDTV Profit. Always a pleasure to speak to you.